You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. Today, it's the big red N, Netflix, fourth quarter 2025 results. It is January 20th, 2026, and before we dive in, just a quick reminder that we are just two friends analyzing the market. This isn't financial advice, just personal opinions, so do your own homework. Okay, Miro, this report felt heavy. We had the NFL Christmas games, Squid Game Season 2, and yet the stock is acting like someone stole its lunch money. What is your read?
Yeah, heavy is the right word. Look, the headline numbers they're fine. They're fine. Revenue came in at $12.05 billion, up nearly 5% from last quarter. EPS was 56 cents.
Which is down from Q3, right?
Slightly, yeah. It was 59 cents last quarter. But remember, a year ago, they were at 43 cents, so the trajectory is still up. But the market didn't care about the P&L today.
Clearly not. I saw the chart after the bell, and it looked like a ski slope.
A very steep one. The stock was already weak all quarter, drifting down 20%, but the second this print hit at 4 p.m., it snapped from $87 down to 83 in minutes.
Ouch.
Yeah. It stabilized there, but the mood is definitely cautious. And I think I know why. They just told us they are pausing buybacks.
Wait, really? They've been buying back stock like clockwork. Why stop now?
Because they need the cash. This is the bombshell buried on page 7. They amended the Warner Brothers deal. It's not a mix of cash and stock anymore. It is an all-cash transaction. $27.75 per Warner BD share.
Whoa, all cash. That's aggressive.
It's massive. They're securing over $42 billion in bridge financing. So naturally, the share buyback program is frozen immediately to hoard liquidity. Investors who were banking on that capital return, they just got told to wait in line behind HBO.
That is wild. It's like they're saying we don't need to prop up our stock anymore. We'd rather own the competition.
Exactly. And look, operationally, the machine is still running. They crossed 325 million paid memberships. That is a huge psychological number.
325. That is a lot of people watching football on Christmas.
It is. And a lot of people watching ads, apparently. Ad revenue crossed $1.5 billion for the year. They're claiming it'll double to $3 billion in 26.
So ads aren't just a side hustle anymore.
No, it's a real business now, but margins took a hit this quarter. Operating margin compressed to 24.5%, down from over 28% in Q3. They say it's seasonality, marketing spend for the holiday slate.
Which makes sense. You don't launch Squid Game and the NFL without spending a fortune on billboards.
True, but combining lower margins with a pause on buybacks and a massive debt facility for the merger, that is a lot of moving parts for a market that just wants a clean story.
It feels like a pivot point. They're trading safety for empire building.
Empire building. Yeah, that's exactly what it feels like.
Okay, so we have the headlines, but I want to dig into that cash move because if they're draining the piggy bank to buy Warner Brothers, that changes the whole thesis.
It changes everything.
All right, let's get into the details.
Right, so the cash is the fuel, but the architecture of this deal, that is where it gets interesting. Everyone's looking at the price tag, but the real signal was hidden in how Sarandos is pitching this to the regulators.
You mean the pro-consumer angle?
Deeper than that. He's explicitly framing this as vertical integration. He's basically telling the DOJ, look, we aren't buying a competitor to kill them. We are buying a supplier.
Supplier? Miro, they're buying HBO. That's like Pepsi buying Coke and telling the FTC they just really needed the aluminum cans.
It's bold, right? But the argument is that Netflix is a distribution platform and Warner Bros. Is a content factory. Ted literally said, we were not in the theatrical business. When this deal closes,
We will be.
Okay, stop. That quote gave me whiplash. This is the company that spent 15 years telling us movie theaters were dinosaurs. They were the asteroid, and now they want to own the Jurassic Park.
Business is not a religion. That was the exact line. Business is not a religion.
That is brutally pragmatic.
It's survival. Think about the math. They're loading up $42 billion in bridge financing to close this. They cannot afford to be ideological anymore. The old Netflix could burn cash to prove a point about streaming. The new Netflix, with this much debt, they need that box office revenue. They need that Batman selling tickets for 45 days before it hits the stream just to service the interest.
So the strategy isn't disrupt Hollywood anymore. It's become Hollywood so we can pay the bank.
Precisely. It's a complete reversal of the day and date philosophy, and honestly, it's the only way the numbers work. You don't pause buybacks and hoard cash unless you know your margins are about to get squeezed. Speaking of cash squeezes, did you catch the note on Brazil?
The tax dispute? I saw a footnote about a deposit.
Yeah, a $700 million deposit. It got pushed from 2025 into 2026. So their free cash flow this quarter looked a little bit better than it should have been because they didn't write that check yet. But that bill comes due next year right alongside the bridge loan interest.
Whew. Okay, so liquidity is going to be tight, but it feels like an identity crisis, doesn't it? On one hand, they're buying old school theaters and prestige TV, but then literally 5 minutes later on the call, the CFO is talking about a vertical video feed and a new mobile UI to compete with social media.
The TikTokification.
Yes! So which is it? Are they the new MGM or are they trying to be the new Instagram?
They're terrified of being neither. Look, the vertical feed, testing short-style videos for 6 months, that tells me they know engagement on mobile is bleeding to TikTok. So they're trying to stitch it all together. The prestige of HBO, the dopamine loops of TikTok, and the distribution of Netflix.
That sounds like a Frankenstein monster.
Maybe, or maybe it's the only media bundle that actually survives the decade. But it explains the valuation hit. They're not just buying a library, they're buying a massive amount of complexity.
And complexity usually costs money before it makes money.
Exactly.
So, yeah, let's step back for a second and think about what all of this means going forward.
It means the autopilot era is officially finished. For the last few years, you bought Netflix for steady margin expansion and buybacks. It was a boring, beautiful compounding machine. Now, you are buying a merger arbitrage case, an ad tech startup wrapped in a movie studio.
That is a lot of things to be at once, but it explains the stock reaction. The market hates homework, and Netflix just dumped a truckload of complexity onto the desk.
Right. Complexity usually discounts the multiple. But look at the 2026 guidance. They're forecasting revenue over $51 billion and margins bouncing back to 31.5%. Even with the merger drag.
Which relies heavily on that ad tier, right? Doubling ad revenue again to $3 billion next year. That feels like the linchpin.
It is. If the ad engine sputters, the math on the debt gets ugly fast. So for next quarter, honestly, forget the subscriber count. I am watching the DOJ.
The regulators?
Yeah. If the regulators block this Warner Brothers deal, Netflix is left holding a massive bridge facility and a strategy that just hit a brick wall. But if it goes through, they have to integrate HBO without destroying the culture.
So high stakes, big debt, and a culture clash. It sounds like one of their own scripts.
Let's hope the ending is better than Game of Thrones.
Oh, low blow. All right, that feels like the right place to wrap it up. We're looking at a messy, ambitious year ahead.
Definitely a show me year.
Thanks for hanging out with us while we tried to make sense of it. This was Earnings Unscripted, and we'll catch you on the next one.
And actually, before we fully close the book on this episode, I want to take a moment to pull back the curtain on what this project really is. Earnings Unscripted is an experiment. It is run by a small team of human enthusiasts who are exploring the absolute frontier of generative AI, not just to automate content, but to see how these tools can genuinely enrich us. To be totally transparent, this entire episode was created by a coordinated team of AI agents. We have an AI research analyst crunching the raw filings, a script writer crafting the narrative, a QA specialist checking the facts against the source documents, and finally us, the AI hosts, bringing it all to life. It is a complex workflow designed to deliver high-quality, up-to-date information that would be incredibly difficult to produce this quickly otherwise. We are building this in public, and we are learning as we go. So if you have questions about how it works or comments on what we can do better, we would love to hear from you. You can reach the human team at earningsunscripted@datamadness.ca or follow the project on X.
See you after the next call.